Alright guys, welcome back. Today is all about stock market crashes, right? We're talking depressions, we're talking recessions, we're talking today's stock market crash. We're talking when will the market bottom, where will it bottom, right? And what I'm going to do is I'm going to take you through some deep research that I have found comparing the 1929 Great Depression, the 2008-2009 Great Recession, and then today's, well, we don't know what we're going to call it yet because we're not going to know how bad it's going to get until we get there, okay guys? So I'm sure that if you found this video, you will have the following questions on your mind. Number one is, will we have a recession? Number two is, will we have a depression? Number three is, will the stock market keep crashing? All right, that's a big question. And where will it bottom? And then should we buy stocks now or wait? Will we have a recession, okay? And I think the answer to that question is undoubtedly yes, because if we look at the technical definition of a recession, it used to be classified as 2 consecutive quarters of economic decline as reflected by GDP, in conjunction with other things like unemployment and whatnot, okay? Today, it's defined as a decline, significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesaler and retail sales, okay? So obviously, yes, we're going to have a huge recession because the unemployment is already about 10 million in terms of the weekly unemployment jobless filings. So there's no doubt in my mind. Now, the next question is, well, if we are going to have a recession, will this be a Great Depression all over again, okay? Now, if you read the news articles, it's very, very doom and gloom, right? People are saying this is going to be worse than the 2008 recession. This is going to be worse than the 1929 Great Depression. This is going to be the worst thing ever. And from what I found, I can't see how that can be true at the moment, okay? Because let's think about the Great Depression of 1929. First of all, we had something called the Smooha Tariff Act, okay? The too long didn't read summary of it is effectively, during the Great Depression, this act meant that the average tariffs for US goods was about 50%, okay guys? 50% tariffs heading to 60% at some point. As a result, US exports declined by about 66, 67%. All right, guys, and that lasted from 1929 to 1932. 3 years where the exports fell 2/3, right? We don't have that at the moment. If you compare that with the current tariff situation, we have China committing to buying more, right? China committing to buying more over the coming 2-3 years. Them upping their buying by at least $200 billion, okay? None of this looks like massively falling exports for the US. The existing tariffs, they were cut from 15% to 7.5%. You had 25% on the first tranche of $250 billion that remains in place, but can be removed as the talks and negotiations proceed, right, in terms of phase 2. The $160 billion of new goods, that has been suspended. All right, guys, the next thing that we're going to look at is the Dust Bowl, okay? And this is another thing which we do not have today. And the Dust Bowl, you can say it lasted 6-8 years, depending on, I guess, where in the States you were and how badly you were affected. But let's say, best case scenario, this was a 6-year-long drought that absolutely destroyed the American agricultural system, okay? 6 years long, you had dust storms flying around every day for the 6 years. The drought was massive. It was cheaper to throw away your crops than harvest them, right? It was an absolute disaster. And back then, back in the 1930s, as a percentage of GDP for the USA, it was 8%, okay? Agriculture contributed 8% towards US GDP. Today, it contributes less than 1%. So we had 6 long years of a massive drought that absolutely destroyed 8% of the American GDP, and I think it was something like they only recovered 25% of their losses in subsequent years, right? And again, today, we just do not have that. All right, next thing that we had back in 1929 that we do not have today was crazy, crazy, crazy lending. And you guys can be saying, well, the CAPE ratio is about 40 or whatever it is before it crashed. I mean, that's absolutely crazy, right? Well, not that crazy, because back in 1929, again, the Goldilocks period was so Goldilocks that your margin requirement was only 10%. In other words, for every $1 that you had, you could margin up $9 whole dollars. Okay, guys, we're talking a 9-to-1 ratio that you could get margin, take it, and then go and dump it into the stock market and into other assets, which is exactly what people did. And lending, you thought 2008 lending was reckless? 1929 was a whole lot worse, let me tell you that, all right, guys? So you had margin at 9-to-1, okay? Today, margin is about 2-to-1, and if it goes to about 30%, you get margin called, okay? Back then, I don't even think the concept of margin call existed back in 1929, which is, again, part of the reason why the Depression was so bad was because none of these sort of checks and balances existed. Back then, you had, at the worst point, 9,000 banks had gone under, all right? So 9,000 banks went under, and in the first year alone of the Great Depression, when the stock market bottomed, you had 4,000 banks go under, and $140 billion of people's money just vaporized into thin air, okay? Now, if you average that out to today, that would be huge. I don't even know how much that would be, like 4, 5, 6 trillion. Who knows, right? A lot of wealth just vaporized into absolutely nothing. Compare that with today, and in the last couple of years, less than 10 banks have failed, okay? And you guys might be thinking, well, hang on, guys, what happened to the FDIC? How could people not get the money back? Well, that's the whole reason why the FDIC came into place and came into existence, was because of the exact happenings back in the Great Depression, where $140 billion back in 1930s just vaporized into thin air. Okay, next thing that happened back in 1930s during the Great Depression, which we do not have today, are two things that meant that the government could not do much to do anything to help the economy or the people, okay? The first thing is you had the dollar pegged at the gold standard. And the second thing is you had this guy here. You had Hoover as the president, and you had the gold standard. Now, the gold standard meant that you could not print into oblivion to offset your current liquidity deflation issue, trying to, reinflate and stimulate, because you had to have the dollar correlate with the amount of gold that you had in your reserves. Furthermore, you had somebody like Hoover, who was absolutely anti-government stepping in, right, and anti-intervention, whatnot. He kind of just kept on trying to balance the books, and as a result, this exacerbated the Depression, right? He effectively just sat back and said, right, I'm just going to let this sort itself out, and then, survival of the fittest, right? And then what did you have? Well, you had a 7, 8, 9 year long depression of 25% of the people became unemployed, okay? Now, what happened was, after that, you had FDR step in, and he started stimulating the system. And some might say, well, FDR fixed the Great Depression. Well, actually, he didn't, because if you look at the unemployment rate, it was still in the low 20s for the first few years, and then it was in the double digits all the way until Pearl Harbor, when America went to war, right? Yet the stock market rebounded. Okay, so the thing is, if he actually did stimulate, right, it would have been a different story. But he stimulated to an extent, but he didn't stimulate enough. All right, guys, and so that's part of the reason, again, why the Great Depression dragged out so long, because for the first few years, you had a president that was initially just going to sit on his hands and let the whole economy and all the people and all the banks go under. You had a deflation of asset prices because people were panicking, trying to get the money out of the banks before it blew up into nothing, into oblivion. And then you had the banks do a fire sale on all of their assets, cents on the dollar, trying to give the money to people so that they can actually cash it out, right? It was an absolute disaster, and we don't have any of that happening at the moment, right? And furthermore, the unemployment rate maintained above 15% for a good, 6, 7, 8 years, and the stock market was still recovering, okay, guys? So, look, that's why I'm not really convinced when people say this is going to be worse than the Great Depression, and we're going to cover later what the kind of stimulus that's happening at the moment to prevent that from happening, okay, guys? Now, let's talk about the Great Recession, okay, guys? And I can conclusively say from my research that this is a lot worse than the Great Recession. However, the caveat to that is that the stimulus and the action taken by the government is multiple folds of what they did during the Great Recession. Okay, guys? Because I think during the Great Recession, they actually undercooked the stimulus. And what we're going to do now is we're going to compare two critical pieces of information that I found during my research. The first thing we're going to compare is the Economic Stimulus Act of 2008, and then we're going to compare the American Recovery and Reinvestment Act of 2009, okay? We won't worry about all of these numbers because we are already, massive numbers of people claiming jobless benefits, okay? So we won't worry about that. We'll worry about the stimulus because, again, the key is how fast and how quickly can we recover, and how much is the government willing to do to backstop the losses, all right? So let's have a look at some key details, right? What we know is back during the Great Recession, you had two sort of key stimulus, regulations and legislation, okay? You had $300 per person, or $600 per married couple, and $300 per dependent child under the age of 17, and you could not exceed $600 for a single person or $1,200 for a married couple. You had some payroll tax credits of $400 per worker and $800 per couple, and then you had a whole lot of this other stuff, okay? I'm not going to read this out in the interest of time, so pause the video if you want to look at this in a little bit more detail, okay? This totaled $237 billion, and I'm talking direct sort of money and aid to people. Then you had all sorts of other things like energy and infrastructure, right? The second thing is you had some tax incentives for companies that totaled $51 billion, and again, that was to sort of allow them to offset their future profits for 5 years rather than 2 years from the losses that they incurred, all right? Now, adding this all up, apart from tax relief and the state and local and fiscal relief, right, which is, we'll just round that up to a nice whole figure of, say, $450 billion. The rest of that you can call quasi-stimulation. Furthermore, we have to keep in mind, okay, during the Great Recession, the Democrats, the Republicans, right, they couldn't come to any sort of agreement, and they were bickering amongst themselves for over a whole year, okay? So from the time they passed the first stimulus, February 2008, to February 2009, they were bickering amongst themselves for a whole year, and they couldn't actually come to any consensus, right? So for a whole year, they faffed around, sitting around with their dicks in their hands, just doing bureaucracy amongst each other, passing this bill, and then looking at the draft, saying it's horrible, right? You had these many people voting for it, these many people voting against it, then you had a reformation of the bill, then you had a rejection of the bill. It was running around an absolute just shambles, right? It was an absolute shambles. They were running around in circles, and it took them a whole damn year to pass the bill, okay? Now, they thought that the bill was going to help the unemployment rate, and they forecasted that with the recovery plan, it was going to go to, just shy of 8%, right? And it easily exceeded that. And I think it wasn't, there were two reasons, okay? The first reason is I don't think they stimulated enough. And then the second reason is because they faffed around for too long, much like what happened in the Great Depression, but not as bad, where people were just sitting on their hands bickering amongst each other or doing nothing while the economy burned, okay? And now compare that with today's current passing of the bill and stimulus, right? $2.2 trillion, the votes were unanimous, okay? Unanimous. This is the first time in American history where the Democrats and the Republicans stopped bickering and got this thing passed within 1 to 2 weeks, okay? And compare that with previously, it took them a whole year and they were bickering, all right? And this was, keep in mind, this was 50% of the entire annual federal budget, and without a shadow of a doubt and without hesitation, they got it done in 2 weeks and they passed the thing. Furthermore, they are now talking about the next stimulus, so further stimulus on top of an already half the annual federal budget, okay? So they are not messing around. And you can say, well, maybe they're overcooking the goose in this instance. And that's actually a good thing for the short term, I guess, to prevent the economy diving into a massive depression, okay, guys? So let's actually compare the details of the stimulus and just how much more substantial this stimulus package is, okay? First of all, they've doubled the amount that people will receive in terms of singles and couples. They've almost doubled the amount that they would get for each child under 17, okay? You had student loans without any penalties for another half a year, and in terms of the actual unemployment benefits, right? You have $600 a week on top of $200 to $500 a week, depending on the state. That comes to $700 to almost $1,200 a week, okay? $700 to $1,200 a week for an extra 13 weeks on top of the standard 12 to 28 weeks, all right, guys? That is absolutely massive in terms of the amount of money that people are going to have, right? So maybe for the first 1-2 months they can't spend it, but let me tell you, the minute that things get out of control, people are going to come out and they're going to have all this money in their pockets, and they will no doubt spend it. And I think that's the exact reason why they did this for stimulus. And then, you know, they even covered people like contractors, right? People that don't typically qualify for the stimulus benefit. And in terms of the lending program, I mean, compare that with previous. They only had a $51 billion tax relief program. Now they've got a $500 billion in terms of loans and guarantees for these businesses. That's not inclusive of the further stimulus that they're talking about pumping into the economy. All right, guys? The numbers are worse than 2009, but I'm not convinced that we are not going to have a massive influx of money and pent-up demand and liquidity being pumped back into the economy once people start leaving their houses, the lockdown and quarantine comes to an end, and then people start spending again. All right, guys, so now let's talk about the market, right? Let's talk about where the bottom is, when the bottom is, and will the stock market keep crashing? Remember, the market, the stock market, okay, it's all driven on sentiment. There's no such thing as fundamentals or discounted cash flow or nothing, okay? The market is an auction, and it's purely driven by sentiment, okay? You could have an absolute abysmal disaster, but if sentiment is great, then the market's going to recover. So let's compare the stock market back in the Great Depression and the series of events after FDR was elected president, okay, guys? Now, they say, oh, we're going to have a prolonged period of unemployment, 20%, 25%, right? 15, 25% long. Well, they had the same thing back in the Great Depression. It was almost 25% when FDR got elected, and yet, if we go down to over here, which was November of 1932, and he got elected, right? You had a big spike, right? And then you had a little bit of a pullback. But then you can see it continued to rally, right? It rallied, it rallied, it rallied, it rallied, it rallied, and it rallied absolutely hard, okay? But yet, if you look at the unemployment rates, 25%, okay, bad. 22% almost, not as bad, but still bad. 20%, 16%. I mean, you have a look at these unemployment rates, right? It doesn't make sense. The unemployment rate was massive all the way until Pearl Harbor, where we had the lead up into World War II, and then yet the market just kept rallying, and it wasn't until we had another sort of mini recession panic that it absolutely got smashed, okay? But you can see from the period of 1933 to, 1938 that it had a huge rally, despite the numbers being absolutely abysmal. And the reason being is because people's sentiment was changing, right? People thought FDR was going to fix the system. People thought we were going to have inflation. People thought the stimulation was going to work. People thought, believed, and felt, right? And that is exactly what the stock market reflects. It's a belief, not fundamentals, okay? Second thing we're going to look at. Now, let's have a look at the S&P 500 during the Great Recession back in 2008, okay? You can see that it absolutely kept crashing past the first crash, and then it crashed and then bottomed out at sort of, late 2009, okay, guys? But here's something that we should pay attention to, okay? Have a look at the series of events leading up to that, right? Like I covered before, you had the people in Congress absolutely faffing around, and they couldn't come to an agreement in terms of how they were going to stimulate and the terms of the stimulation, to the point where the stimulation got rejected, okay? The stimulation got rejected, and the very next day, the Dow crashed, almost 780 points, all right? So this was the day that the stimulation got rejected, and then this was the day of the crash. So you can see that good portion of the crash over here was as a direct result of the sentiment and confidence being, absolutely shattered, right? Because, yeah, you can say they passed the stimulus the very, very next month. In fact, just a few days after, 4 or 5 days after, they passed it because they saw what happened to the market. But again, people's sentiment and confidence has been smashed, and that is exactly why the market kept crashing. But in this instance, again, we don't have that. We have the mother of all stimulus in the history of the USA that they've ever seen get past 2 weeks unanimously with no bickering amongst the politicians. Okay, guys? Absolutely massive. So the question is, do I think the stock market will keep crashing? I think that there is a likelihood, but I don't expect it to go to the pits. You know, some people are saying 14,000 on the Dow, 10,000 on the Dow. You know, okay, I don't think it's going to get to that point. I think that as long as sentiment and confidence remain, well, I wouldn't say high, but remain solid, all right, and we see things improving and stimulus keeps coming, right, and people just keep, you know, just give me a bit more. It's like a drug addict, right? Feed them a little bit more, you know, and give them a little bit more so they come out the other side, okay? I think that if it does keep going down, I think that the stock market will bottom between 1,900 and 2,100 points of the S&P 500, okay? So, you know, it's still a way down, right? It's 20% from today's number, roughly 20, 25, 30%, okay? But again, I'm not too sure if the likelihood is there. I'd say it's 50-50 at the moment, okay, guys? And again, you know, I'm not an economist. Nobody can time the market. Nobody can predict the bottom. But based on this, I'm confident to continue to invest my capital during this time because I think that there are some good opportunities, some good bargains, and some good deals out there. And, you know, if it crashes, I'll just buy more. But that is my take on, you know, depressions, recessions, and whether the stock market will keep crashing and when and where the stock market will bottom. Okay, guys? Now, 4 years from now, we might have a massive hyperinflation problem. Okay, but that's a story for another day. Okay, guys? So until next time, happy investing.